Most people don't lose money in markets. They lose it in poorly structured portfolios. They chase returns, they chase the next big thing, but they don't stop to ask the basic question. Is my portfolio actually designed to work across cycles? In my previous video, we learned how the US plus India strategy works, why global investing is no longer an option, why most international investing strategies fail, and why, if you're building wealth from 10 lakh to 10 crore, India and US are the only two markets you actually need. If you haven't seen that video, I'd recommend seeing it first. I'll link it here. Today's video is all about execution, not opinions, not forecasts, but how to structure this portfolio properly. Today in this video, I'll walk you through exactly how much allocation you need between India and US, what to buy, how to invest from India and the US, and exactly how the taxes and compliances work. This part isn't exciting, but actually, this is the difference between a portfolio that looks good on paper versus the one that actually compounds for decades. This is the first question everyone asks. How much of my portfolio should be in the US? Here's the core principle you need to remember. If India is your home market, you should have majority holding here. You have the information advantage, knowledge of how businesses actually work, and behavioral comfort. The US is not a replacement for India. It's a diversifier, a currency hedge, and an exposure towards innovation. If your portfolio is under 50 lakhs, your India size should be around 85 to 90% and your US should be around 10 to 15%. At this stage, you're still accumulating wealth and the higher growth rate of India matters more. The US part should mainly be used for currency diversification and to get comfortable with international investing. If your portfolio size is between 50 lakhs to 2 crores, your India investment should be around 75 to 80% and your US should be 20 to 25%. This is the sweet spot for most professionals. You're on your way to building serious wealth now. A 20 to 25% US exposure ensures that it actually meaningfully impacts your portfolio performance. There's a real currency diversification case here and great exposure to innovation. When your portfolio is between 2 to 5 crores, your India portion should be around 65 to 75% and your US should be 25 to 35%. At this stage, you're in the affluent and HNI category. Wealth protection becomes as important as wealth creation. A 30% in US assets gives you substantial currency diversification and a strong cushion to protect when India markets correct. Once your portfolio reaches 5 plus crores, your India should be around 55 to 65 and US should be 35 to 45%. At this level, you're thinking in generations, not just in pay cycles. Having a third or more of the world's deepest, most stable market makes sense, especially because the rest of your assets, like your home, career, commodities, will be in your home country currency only. Once the allocation is clear, the next question is, what should I really buy in the US? And this is where most people overcomplicate things. For 95% of the investors, the answer is just two holdings. The exact funds may change over time, but the structure doesn't. Holding number one, the S&P 500 index. This should be almost half of your US portfolio. What is S&P 500? It's 500 of America's biggest, most profitable companies. It's market cap weighted, which means the bigger companies have bigger influence. Includes companies like Apple, Microsoft, Google, Nvidia, Tesla, and more. But it also has finance, consumer goods, healthcare, energy. It automatically rebalances as the companies grow or shrink and has 150 years plus of data. Why this works? You get broad diversification across all sectors. It's extremely low cost with expense ratios almost 0.03% if you buy direct. If you're not just betting on the tech sector, you're getting the entire American economy, so it has lower volatility. Holding number two, the Nasdaq 100, which should be rest of your 50% allocation. The Nasdaq 100 gives you the top 100 non-finance companies in the American market. It includes primarily tech, but also consumer and healthcare. It has the Magnificent Seven, which is Apple, Google, Microsoft, Nvidia, Tesla, etc. Historically, the Nasdaq 100 has given higher returns than the S&P 500, but with higher volatility. So why I recommend 50-50? India already gives you exposure to pharma, healthcare, infra, consumer. So you don't need to overinvest again in the same sectors in the US. The Nasdaq 100 concentrates on tech and innovation, what India lacks. So it gives you a higher growth potential versus the S&P 500, which gives you exposure across all sectors, diversification, and protection if there is ever a tech fall or a tech downside correction. Together, you get the best of both worlds, growth from innovation and stability from diversification. That balance works. But what about sector funds or individual stocks? Let me address this because I know some of you might be thinking about it. For portfolio till 5 crores, the Nasdaq 100 plus S&P 500 strategy is enough. You don't need more complications. But in case you want some thematic investment, limit it to 10% of your portfolio max. You can explore themes like AI, semiconductors, or any strong trend that you have high conviction on. But honestly, with Magnificent 7 included both in the Nasdaq 100 and S&P 500, your AI exposure is already quite a lot. You probably don't need more. For portfolios above 5 crores, you can now consider individual stock picks. Do this only if you have time to follow the news, track management calls, understand the US company and the economies very well, and if you're willing to take concentrated bets. But if you're not, honestly, the earlier 50-50 strategy works just fine. You'll probably beat more than half the active investors anyway. The S&P 500 captures American capitalism and the Nasdaq captures American innovation. That's all you need. All right. Theory is done. Now let's talk execution. How do you actually get money into the US markets? You currently have two routes to do this. And I'm going to talk about exactly what works under which portfolio size and the taxation that comes along with it. The framework holds even if more routes get added. Route A, investments routed through an India-based wrapper. Indian mutual funds, feeder funds, etc. Route B, direct foreign holdings, US brokerages, global trading accounts, etc. Some platforms may sit in between these two routes, but they still fall under one of these two buckets. Route A, India-based wrappers, such as the Indian mutual funds. So how does it work? Several Indian AMCs offer international exposure funds. You invest directly in rupees with these funds through your regular mutual fund broker, Grow, Zerodha, ET Money, whatever you use, and they handle the entire process from currency conversion, compliance, exposure to the US market, everything. There are multiple available options. The pros are that they're dead simple to use, no currency conversion hassle. You can start with as little as 500 rupees in an SIP format. There's no LRS, no separate taxation required, and automatic rebalancing whenever the index moves. The cons are that the expense ratio is slightly higher than direct ETF investment, from 0.5 to 1% versus a 0.03% to 0.2%. Also, you're adding an extra layer between you and the underlying asset. So who is this for? For beginners who are new to international investing, who are just getting comfortable around it, for people whose portfolio size in the US is less than 50 lakhs, and those who prioritize simplicity over cost optimization. Route B, direct US brokerage. Platforms such as Interactive Brokers, IND Money, Vested. So how does it work? You open an account on the app, do your online KYC, transfer money, usually takes around 2 days to reflect in the US brokerage account. And once you have that money in dollars from rupees, you can start investing like any normal app. You can pick a stock or an ETF or whatever you like. The pros are that you have direct access to thousands of stocks, bonds, ETFs, and commodities. There's no added layer in between, and hence there are lower costs for long-term and larger investments. Also, you can do real-time trading during US market hours. The cons are that it's slightly more complex. You need to understand LRS, TCS. There are both ways Forex charges, the costs of currency conversions, and you need to understand the US markets trading hours. So who is this for? People who are building long-term US exposure with 50 lakhs plus portfolio size, anyone who wants direct control and lower costs, and those who are comfortable with a little bit of paperwork and compliance. Alright, let's tackle the part which everyone dreads but needs to understand: taxes. I'm going to show you which route actually gets you higher returns after taxes and fees. The taxes rules can change, but the framework remains the same. Route A: if you invest via India mutual funds. So these are taxed similar to the debt funds. If you are holding it for less than 2 years, short-term capital gains of your tax slab rate will apply. For example, if you're in the 30% bracket, 30% tax will be applied on any short-term capital gains if it is sold within 2 years. That is why flipping in and out of these funds is more expensive. If you are selling after 2 years, long-term capital gains will apply, which is 12.5%. So for example, you invest 10 lakhs, which becomes 16 lakhs after 4 years. Your net taxable gains is 6 lakhs, on which you have to give a tax percent of 12.5%, which is 75,000. Then comes the expense ratio impact of over 4 years, which would be around 1.8 lakhs. So your net wealth after tax and fees would be around 14 lakhs. This gives you an effective return of 44.5% non-annualized. The key takeaway is that it's good for buy and hold for at least 2 years, not trading. Route B: if you invest via US brokerage funds directly in the US stock market. US does not charge any capital gains to NRIs. However, India charges you on worldwide income. If you're holding for less than 2 years, short-term capital gains would apply, which is according to your tax slab rate. And if you're holding for more than 2 years, long-term capital gains would apply, which is 12.5%. So in the same example as before, assuming you invested 10 lakhs and you got 16 lakhs after 4 years, the net tax remains the same. However, the expense ratio in terms of fees changes. With around 0.03% and a minimal forex conversion charge, your expenses after 4 years would come out around 30,000. So your net returns after taxes and fees would be around 15 lakhs in this case, which would translate to an effective return of 55% non-annualized. So dividends are charged slightly differently. The US claims tax on dividend income earned. So step 1, the US claims around 25% tax on any dividend income earned. So if you earn around $100, 25%, $25 will be with the US. Step 2, India also charges dividend income tax according to your tax slab returns. So if you are in the 30% bracket, you will be charged 30% on your any dividend income. Step 3, foreign tax credit. If you've already paid 25% or $25 to the US government, you can claim credit for that $25 spent and pay additional tax of only 5% extra if you are in the 30% tax in India as well. So for example, $25 is already paid to US. You only need to pay $5 more in the Indian taxation system. Bottom line on dividends, they are double taxed. Both countries take a cut on these dividends, which is why growth-focused ETFs, which pay out minimal dividends, are a better long-term option than dividend-focused ETFs. Now comes the execution strategy and common mistakes to avoid. Mistake number 1, don't time the market. I know what you're thinking. The US market looks too expensive right now. Should I invest or should I wait till it corrects? Here's the thing, the US market has been looking expensive since the last 10 years. People have been calling it overvalued since 2015 and it still delivered great returns. You're not investing for the next 6 months, you're investing for the next decade or 2. If your time horizon is this long, then timing the entry point is actually pointless. Also, you should rebalance annually, not constantly. Don't try to exit from India and invest in US, but redirect any fresh investments in the next 6 to 12 months into your US portfolio until you come to your desired ratio. Mistake number 2, not starting because it feels too complicated. The biggest enemy is analysis paralysis. Yes, there are terms like LRS, TCS, Schedule FA to understand, but it's manageable. You can start small with the Indian mutual funds, get comfortable with international investing, and then move to direct US brokerages once you're there. Don't let perfect be the enemy of good. Mistake 3, going all in on US and ignoring your India allocation. Mistake 4, chasing the next hot stock. Nvidia is up 10x, I should buy it now. AI is the future of the economy, I should put everything there. But by the time the news has reached your ears, smart money has already made its gain and exited. You are literally buying at the top. Let me end with the most important part. This is a 20-year strategy, not a 2-year trade. Anything can happen over the 1 year. The US can outperform India. India can outperform US. The markets can rally or crash. The rupee can strengthen or weaken. None of that matters. What matters is that over 20 to 30 years, both India and US have structural advantages. Both will have long-term compounded gains for the holders, and both the markets lack perfect correlation, so it reduces volatility of your overall portfolio. Your grandparents' generation kept 100% in India because there was no easy way to invest globally. Your parents' generation probably keeps 100% of their wealth in India as well because that's how they've always done. But your generation has access to global investments at the click of a button. You'd be foolish not to use it. If this video helped you think clearly, subscribe to the channel. Tell me in comments, are you already investing outside India? And what do you think about investing in other markets? If there's anything specific you need me to deep dive on, let me know. I read all comments of yours. I'll see you in the next one.